Today, we're diving deep into the absolute bedrock of trading, the engine that powers every single market move. I'm talking about supply and demand. Now, I know what you might be thinking. Ugh, economics class flashbacks. But trust me, this isn't your dusty old textbook lecture. We're going to make this fun, energetic, and most importantly, super practical for your trading journey. By the end of this video, you'll see the market not as a bunch of random squiggly lines, but as a dynamic battlefield of buyers and sellers, and you'll know exactly how to spot where the real power lies. So, what is supply and demand in its simplest form? Forget charts for a second. Imagine you're at a farmer's market. There's one farmer with a single basket of the most amazing, juicy red apples you've ever seen. But guess what? 100 people want those apples. What happens to the price? It skyrockets, right? People will be outbidding each other. I'll pay $5. No, I'll pay 10. That's high demand and low supply. The sellers have all the power. Now, flip it. Imagine the same market, but this time, 50 farmers show up, each with a truckload of identical apples. There are way more apples than people who want to buy them. To get rid of their stock before it rots, farmers start slashing prices. Apples, $1 a basket. Please, just take them. That's high supply and low demand. Now, the buyers have all the power. That's it. That's the core concept. Trading is just a massive, global, digital farmers market for assets like stocks, crypto, or forex. The price you see on the screen is simply the result of this constant tug-of-war between buyers' demand and sellers' supply. When demand overwhelms supply, prices go up. When supply overwhelms demand, prices go down. Your job as a trader is to become an expert at identifying these imbalances before the rest of the market catches on. So, how do we see this on a chart? This is where it gets exciting. We look for areas of consolidation or basing. These are zones on the chart, where the price moved sideways for a while before making a big, explosive move either up or down. Think of these zones as the market coiling up like a spring, building up pressure. Let's talk about demand zones. A demand zone is a price area where a sharp rally began. Why is this important? Because that sideways action before the rally was a period where big institutions, the smart money, were quietly accumulating their positions. They were buying up all the available shares at that level. When all the sellers were gone and only buyers remained, the price had no choice but to shoot up. When the price returns to this zone later, there are often left over by orders from these institutions, and other traders who missed the first move are eager to jump in, creating a floor of support and pushing the price up again. It's like the market has a memory. It remembers, hey, this is the level where the big buyers stepped in last time. It's a bargain. On the flip side, we have supply zones. A supply zone is a price area where a sharp drop began. This is the opposite scenario. The sideways action before the drop was a period of distribution. Big institutions were offloading their massive positions to unsuspecting retail buyers. Once they were done selling and only sellers were left in control, the price collapsed. When the price revisits this zone, there are often leftover sell orders, and traders who got trapped in the drop are desperate to sell at their break-even point. This creates a ceiling of resistance, pushing the price back down. The market remembers, whoa, this is the zone where the big sellers took control. It's too expensive here. Let's get practical. How do you draw these zones? It's not about a single price line, it's an area. For a demand zone, you typically look for the sideways price action right before a strong move up. You can draw a box from the low of that consolidation area to the open of the first big green candle that broke out. This box is your demand zone. For a supply zone, you do the opposite. Find the consolidation just before a big drop and draw your box from the high of that area down to the open of the first big red candle that broke down. The strength of these zones is key. A powerful zone is usually formed by a very strong, fast move out of it. Think of a rocket launch versus a slow crawl. A big, explosive departure from a zone tells you there was a massive imbalance between buyers and sellers. That's a high probability zone. A zone that has been tested many times gets weaker. Think of it like knocking on a door. The first time, it's strong. The 10th time, the hinges are getting loose. Eventually, it's going to break. Fresh, untested zones are where the highest probability trades lie. So, how do we trade this? The simplest strategy is to wait for the price to return to a pre-identified, fresh demand or supply zone. If the price enters a strong demand zone, you look for a buy signal. You could place your stop loss just below the zone and target the next supply zone or a previous high. Conversely, if the price enters a strong supply zone, you look for a sell signal. Your stop loss goes just above the zone, and you can target the next demand zone or a previous low. Remember, this is not a magic crystal ball. Nothing in trading is 100% guaranteed. That's why risk management is your best friend. Always use a stop loss. Always know how much you're willing to risk on a single trade before you even enter it. Supply and demand trading gives you an edge, a high probability setup, but you have to respect the risk on every single trade. Let's recap what we've learned. The market moves based on the imbalance between buyers' demand and sellers' supply. We can identify these imbalances on our charts by looking for demand zones, where price is likely to find support, and supply zones, where price is likely to find resistance. Strong zones are created by sharp, explosive moves. Fresh, untested zones offer the best trading opportunities. We trade these by looking for entries when price returns to these zones, always using proper risk management. Start looking at your charts this way. Instead of just seeing candles, see the story, see the battle. Where did the buyers show up in force? Where did the sellers take over? Practice drawing these zones on historical charts. Backtest it. See how price reacted when it came back to these areas. You'll be amazed at how often the market respects these levels. This is the foundation. Mastering this concept will fundamentally change the way you view the market. It's about trading with the flow of the big money, not against it. It's about buying where they buy and selling where they sell. It's a powerful perspective that can bring clarity and confidence to your trading. Thank you so much for sticking with me through this deep dive. I hope you found it valuable and that it sparked a new way of thinking for you. If you enjoyed this video and want more content that breaks down trading concepts in a simple, actionable way, do me a huge favor and hit that like button. It really helps the channel out. And if you haven't already, make sure to subscribe and ring that notification bell so you don't miss our next video. Drop a comment below and let me know what you think about supply and demand trading. Until next time, trade smart, trade safe, and I'll see you in the next one.